Hey everyone, I hope you're all doing well out there. This is your April market review. So for those of you that have not watched these videos before, the reason that I put these videos together each month is to give my clients the straightforward information about what's going on in the stock market, the economy, and then ultimately how that affects their investment portfolio that I help them manage. So this past month, pretty crazy month in the stock markets. I'm sure most of you are all aware of it. There was the tariff announcements in the very beginning of the month. I had put together a video just about like a week and a half after that, talking about all of the tariffs that had come out and the drop in the stock market that had happened, where the market in about 2 days dropped off about 11% after that. The following Wednesday, President Trump then announced that there was going to be a 90-day pause on those tariffs so that we could work through negotiations. Stocks then jumped 10% in that day. So the first chart I have here is showing you some of those gyrations that we've had here over the last month. This is a chart of the S&P 500 for the month of April in percent form. So you can see the big drop off the first couple days with the market dropping off over 10% in those first couple days, following into the following week. And then there was, I believe it was April the 8th is when the stock market went up 10% at that point. So kind of cutting into a lot of those losses. We then had a little bit more of a drop off in the middle of the month where stocks went back down to being down 8% for the month. And then with the market movement that we had the last full week of the month, which was last week, I'm shooting this April 30th just to kind of give you a perspective here. The market had taken off and has rebounded back pretty much to almost break even. It's down 1% still for the month, but a pretty big comeback that we've had, considering all of the wild headlines and other things out there. So this is a great example of, one reason of why you stick with it and you don't just all of a sudden, because of headlines or perception of what's going to happen with the economy or political beliefs, especially this past month. With political beliefs, if you felt very strongly against what President Trump was doing, I talked to a number of you out there that were ready to pull the ripcord and head for the hills. And this is the exact reason why you don't do that. So, and the reason being is that, things move the other way for some of the same reasons that they move down, actually. So, great example of why sticking with a strategy is important. These kind of things give me the opportunity to make adjustments within the portfolio and take advantage of some movements going on. The last thing typically you would want to do when markets are down like that is sell positions. So one of the things that I was actually doing that following Monday, right before not that I knew that this was going to happen because no one did, but that Monday after the markets had dropped off and then they continued sliding a little bit further, anyone that had cash sitting in IRA in excess of the 1% norm, I put that to work within the IRA. So, just getting more of that cash invested just to take advantage of that drop off that we did have in 2 days, because it felt very overblown. Whenever you have a movement like that in stocks, regardless of what the reason is, it's pretty well going to be some emotional selling at that point, which is what I felt was happening. Then obviously President Trump announced the hold on things and things rebounded back. So those were just some of the small tweaks that I had made within the portfolio over that time frame. So great lesson though of just why to stay invested within a portfolio and sticking with the strategy and sticking with a longer term plan. And if anything, taking advantage of the opportunities. This was very short lived. When I put my last market review out, I believe kind of right around that time frame when markets had dropped off, and I think it might have been actually right after Trump announced the pause in tariffs, when markets then rebounded. But they were still down at that point on a month-to-date basis, and they were still down close to they were just above 10% on the year at that point, down about 10% on the year. So one of the things that I talked about at that point was doing Roth conversions, adding more money to portfolios, becoming more aggressive in portfolios. When we get those types of drop-offs, and I know for everybody out there, when you're looking at your account balance, you're looking at it and you're like, damn, things have dropped. And it's not exciting. No one likes seeing an account value drop in value. I see it from a firm level. So when you're seeing your accounts drop and maybe the tens of thousands or hundreds of thousands, just depending on your account size, I'm seeing it moving in the millions, which is crazy to see that level happen. So on a firm level basis. So no one's excited to see that. I'm probably top of the list of it, but at the same token, it just creates opportunities. And there's no reason ever to panic within an investment strategy. And really, if anything, it just creates good opportunities to take advantage. We didn't really have a long window to do that, though. And that's been a very on-trend type of thing going way back to even COVID, when the markets had dropped off 35% in about 5 weeks from February 19th, which just so happens to be the peak of the market recently, is February 19th of this year. February 19th of 2020 was the peak of the market at that point. March 23rd of 2020 was the bottom of the market for that year. By August of 2020, we were right back to where we were February 19th. So it wasn't a long time frame that markets were down. And part of that's just because markets are just very efficient and they're pricing in news pretty consistently, and the things are just moving at a faster pace. So even during 2022, stocks were down for 9 months straight, and pretty consistently going lower and lower because of interest rates going up to help lower inflation. And then all of a sudden the tide turned, and then stocks were up, from that point of October of 2022 all the way through February 19th. They were up pretty much straight in almost a stair-step manner with very little drop-offs in between there. So this was one of the first drop-offs that we've had of any significant portion. So I understand where, if you're investing money and you see your portfolio value drop, you get a little weird and panicky because you're just not used to it. It's very normal for stocks to drop off 10%. And historically speaking, we get 10% pullbacks roughly about every, and that's a 10% drop from a recent high is called a correction. It happens roughly on average about every 18 months, which just so happened to be almost right in line statistically with where we're at before then, because the last drop that we had of that level was going back into the summer and the fall of 2022. So kind of right on cue, we had a correction. So it's normal for that to happen. It's actually healthy, and it gives opportunity for new money, new investors to then buy those shares. Inevitably, those people that are selling those shares are gonna eventually probably want to buy back in, because typically those are the panicky people that are selling, whether those are individuals or institutions that are selling, and those people ultimately end up losing money. So being that you're my client, we're gonna avoid that. I'm gonna talk you off the ledge when needed, but just know that long term, that markets and investment strategies work long term. So all of these things in a short-term sort of lens are always going to have more extreme fluctuations with them. So another chart that I have here, I just wanted to bring up, just to kind of give you the highlights of where we're at, is the S&P 500 for the year. Currently we're down 5.3%, which at one point we were down close to 15% for the year. So and we're actually, from the peak, we were up mid-February about 5% for the year. So we're actually down almost in what's called bear market territory, where there's a 20% drop from the peak of the market to a bottoming point, which was just kind of mid-April timeframe here. So I wanted to bring that chart up just because I thought it was important, just kind of give you a highlight of where we're at. But big picture, 5% drop is not anything of any significance. So don't let the media, kind of fool you into thinking that we're in some terrible stock market environment. We're not. Down 5% is pretty minimal, relatively speaking, and the fact that we're right within striking distance of being break even again. Now I feel that we're going to go through some more volatility just because of the trade talks. There's also, we're in the middle of earnings season, so companies are reporting earnings, which just tonight on a positive note, Meta, which Meta is the parent company for Facebook, Instagram, WhatsApp. Meta reported better than expected growth, and which is a good sign because Meta is making money off of selling ads to small, medium, and large size businesses. So if people are still, or businesses are still spending money on ads, that means they still feel pretty good about their business. And that's a good sign overall for the economy. It's a good sign for companies that are looking to grow and invest more money back into their business, that a company like Meta is making a lot of money. Because just for example, if I were to want to try to do more advertising and get more clients, I might do a Facebook campaign to target a certain demographic. Well, if I feel that way and I'm going to spend that money to do it, it's because I'm investing back in my business, and I feel that I'm going to get a good return on that. If I didn't really feel good about my business, I probably wouldn't be spending money on advertising because I'd be worried about not making as much in revenue or something like that. So and investing in that way. So typically when people are investing in advertising, great sign for businesses. Microsoft also reported better than expected earnings as well. Also a really good sign because Microsoft is the one of the three largest technology companies out there. Technology, if you have an IRA of any sort with me, that's the largest part of your portfolio because that's the largest sector in the S&P 500. And within that segment, Microsoft makes up about 20% of that technology fund. So really important. Both Meta and Microsoft were up about 5-6% after reporting those earnings. So that's a really good sign. Getting into another chart here that I had that goes into this is for more of my clients that are on the conservative end of things. I use a lot of times within if you have an IRA and you're more conservative with me, I'm using these buffered strategies, or I'll refer to them as options-based strategies. So this chart that I have up is showing the buffers that I use, or at least two of the buffers that I use, the January and June buffer versus the S&P 500 this year. So the S&P down 5.3%. The buffered strategies, they have a buffer of 15% on them. Right now they're down 2%, 2.1 and 2.5%, respectively. The different months spread out kind of a little bit of the risk diagram there, so they're not resetting in the same month, but they move relatively aligned with each other there. So, but you can see when the markets really dropped off and they were down 15+% for the year, that while those buffers were down alongside of it, they weren't down nearly to the degree, because the way that it works is that if the overall S&P were to be down anywhere from 0 to 15% for the whole year, this is where I'll pull up another chart here showing you the risk diagram for the January buffer. So you can see in here the chart showing the fluctuation of the January buffer versus the S&P 500. The S&P 500 is in the light blue. The darker blue is the actual fund price itself for the buffered strategy. So you can see when the market dropped off, it was down as much as 15% for the year. While this was down a little over 5-6%, the fund itself, if we were to fast forward and stocks were down anywhere from 0 to 15% for the calendar year by December 31st of this year, we wouldn't be down within this strategy. And that's one of the reasons that I use this within IRA portfolios, because it still protects us against the downside of the S&P 500, but it gives us upside potential if stocks do move higher, and it has a cap on it of a little over 12% for the year. So it's a great way to still participate with the upside. This has been something that if you've been working with me, I've had in portfolios going all the way back through 2020. I use this as a replacement of bonds just because bonds over the last 5 years have been a terrible place to have money invested, especially conservative money, because it just hasn't made anything. So I've used this to replace it, but I still want to make sure that we're mitigating some risk against potential market drops. So in a really extreme situation, say markets were to drop 20% for the year, we'd be down 5% if we held throughout the whole year. So there's some different things that I could do if we're down pretty significantly in the overall market, because if the market's down say 20% for the year, that means that we'd be down only about 5% by the end of the year. So that allows for us to not go down as much, but then also maybe take advantage of the upside rebounds eventually. So, but I just wanted to show you that, just to kind of give you some of the under the hood of how your portfolios are working. While, some of your portfolio that is fully invested in stocks is going to fluctuate all the time with the overall market, there's other parts that are hedged against market drops. This is one of the more conservative parts of the portfolio. So, for those people that are concerned about market movements and fluctuations, just know that that's a part of your portfolio. And for those that are more conservative or withdrawing money, you have about 40% of your portfolio in conservative types of investments like those buffers. 5% of that would actually be in short-term treasuries as well, just to help really mitigate the fluctuation of the market, especially if you're taking withdrawals from it, because that's the part of your portfolio that I'm actively going to be pulling from, are those short-term treasuries if the market's down like it has been. So one of the reasons why you don't want to take much more than 5% from a portfolio, and that's one of the reasons that I have 5% is in treasuries. So then that way we can make sure that if we do get a big market drop off, that we're not going down along with it at all for the portion that we're taking out of the portfolio for that year. So, but over time, you definitely don't want to be taking out much more than 5%, because you're going to tap into the principal of your portfolio. So I know I've talked with a number of you as you're entering those retirement years where you're pulling that money out from your accounts. But that's just kind of a rule of thumb that we don't want to take much more than that, because if we're going to target, say, a 7% rate of return in your portfolio and we're withdrawing 5%, that means on a net basis, your portfolio still grows at 2%, but that 2% is just going to allow you to keep up with inflation. So, if you're 60 or 65 years old and you live for another 20 or 30 plus years, you're going to need more money in 20 or 30 years to spend like it does today, just because of inflation. So that's all of kind of how I'm constructing the portfolios and why there's parts of the portfolio that are set up that way. So in years like last year where the market's up 25% and those more conservative portfolios were only up about 18%, while that's great, the reason that it wasn't up 25% is for times like this when the market's down and we don't want to be dropping off as much. So but those are some of the charts that I came across that I wanted to hit on and talk more about with you guys for the month. If you have any specific questions about your portfolio, don't hesitate to reach out to me. We can have a phone conversation or set up a Zoom call. I'm going to be up in Pennsylvania meeting with a lot of my usually regular people that I'm doing in-person reviews up there with. That we don't connect via Zoom. So there's a couple week window where I probably won't be available as much to do Zoom meetings. That'll be from May the 12th through the 23rd. But otherwise, if you want to do a Zoom meeting outside of that, definitely available to do that. Always feel free, just give me a call, text if you have any questions. Happy to help in any way. If you come across anybody that you think would be interested in having an investment related conversation with me, to look at their portfolio or just talk a little bit more in general about their investments or overall retirement plan, happy to talk to anybody that you introduce me to. Just send them my info or give me their info and I'll reach out to them, whatever works best. But I appreciate you all taking the time to check me out. Until next time.